Hi everyone, my name's PK. I have Colin Rice. He is a mortgage broker, has been that for around 15 years. He's also a property investor for around 24 years. He started in the year 2000 being a property investor. And in this episode, we're going to bring you three really juicy tips to improve or increase your borrowing capacity. As you guys know, over the last sort of maybe 2 or 3 weeks, I've gone and done other videos with a lawyer, with other mortgage brokers on how to improve borrowing capacity, especially around potentially getting unlimited borrowing capacity through a trust structure. We went into that real deep. And then I asked Colin more recently if he can complement or supplement that type of analysis or that type of understanding with other tips. Last week, I shared an episode on how to improve your borrowing capacity using tier two, tier three lenders or non-conforming lenders. So we've covered the trust space, we've covered the non-conforming lender space, and in this episode, we'll go through other ways by which you guys can improve your borrowing capacity, which I know that you want to learn more and more and more about. And at the end of the session, or for the second half, I should say, we're going to go through maybe 10, 15 questions on just what's on top of your mind. These are the questions that the members in our Facebook group, Australian Property Mastery with PK, asked of Colin. So things like how to get a lower rate, all about cross-securitisation, how to get a valuation and some tricks and tips around that, which are the best banks, LMI exceptions, what makes a great broker, etc., etc. So we're going to go through some Q&A at the end, but we'll start off with the three biggest tips on how to improve your borrowing capacity. And Colin's a great guy. He's been on the Facebook group for a long time, always really does his best to try to help everyone. He's based in Perth, and he, of course, helps people in Perth, but also nationally, even internationally. And he's got a wealth of experience. So I'm really excited for this session. And thank you so much, Colin, for being here. Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you.
Thank you for that introduction. That's appreciated. Yes, I've listened to the three videos that the other brokers posted, and the tips that they gave were excellent. And I've tried to come up with three original ones. So the first one I'm going to begin with is in regards to how lenders will assess your rental income. They typically shade it by 20% of whatever the gross amount is per annum. And then they will also factor in that you have expenses related to the property. And that's usually 10% of the gross loan amount divided by 12. So it gives you a monthly figure. And there's a lender that I use. They are a third tier lender. Don't really like that term, but it's the best one that people understand what that lender is. And they don't actually put in the property expenses. So you can add essentially $200 to $300 or $400 to your borrowing capacity per month. So that's one little niche lender. I'm not sure whether I should name the names of the lenders. I know other brokers have steered away from it, so I'll probably just stay on the same track, but happy to discuss that if people want to explore that particular lender, that particular niche.
It's a stupid question from my side.
Sure.
Because I think people might be wondering, why are brokers a little bit reticent on naming the lenders? Is it because the policy can change real quick or some other reason?
I think it's more to do because I put together a folder, I don't have one now, and I used the lender's logos. So to do that, you had to ask permission. So they have their own marketing departments, and when you do use their logos or perhaps even, I'm not sure if it goes as far as mentioning their name, then you need to get permission. So it's better just, that's the reason that I understand anyway.
Makes sense.
So we can get into the next number two if you like.
Yeah, let's go for number two.
Okay, number two was an interesting little one. It was actually a real life scenario. Obviously, won't name names, and they'll probably be able to work it out if they're listening. So, hello. And I think I actually got them from your group. So, thanks for that. So,
Yeah.
in this particular case, they saw another broker, and the borrowing capacity, according to them, was around about $500,000. So, the customer or the client wanted about $700,000 or $800,000, and they came and saw me, and I managed to, just by ringing around and just by thinking about things and their current situation, where they are and where they want to go, I just discovered that their fixed rate, which they happen to have at one lender, had about another 9 months to go. And then the next lender that I took them to, I asked them, they've got a fixed rate, what can you do? And instead of doing it at say 6.5% plus a 2.5 to 3% buffer, they just did it at 5% flat. Because they were an alternative lender or second or potentially third tier lender, then they can do things that are outside the box. So that, combined with a couple of other things, gave them the borrowing capacity that they needed to not only buy the property, then when we go back in a year's time and get it revalued, then we can access any growth or available equity. So essentially getting their deposit back. So,
Right.
yeah.
If someone
Hope that
wants to
makes
do
sense.
that with their own broker, like let's say someone's a property investor, want to be a property investor, let's say borrowing capacity in that same example, right? Like the borrowing capacity is enough. Maybe it's only like 200K, 300K, whatever.
Mm-hmm.
What's like the question that they should be asking their broker so that their broker can get the same outcome that you did?
I tell, when people come to me, I listen to what they want to do, where they currently are, and then where they want to go and how to get them there. And a saying that I use is, I'm like a dog with a bone. So I won't let go. I'll look at something, and 9 times out of 10, even just through intuition, by doing it so long, I can look at someone's asset and liability, do a quick serviceability, and then I know this is going to be a deal or not. So yeah, it's about I don't know if you're born with that or that's something you develop. So it's just tenacity.
Yeah.
And I just find out they're nothing dodgy. Like, I find out legitimate loopholes of how to get things done better. And it's just by thinking about it and by asking the questions to the BDMs and really drilling them down on certain subjects. And I know that, say, another lender will do that. So because there's another lender that would have done it at actual repayments. So no buffering required at all. So then I thought to myself, well, perhaps this lender that I'm approaching will do something similar. So I just asked the question, fired off a quick email to the BDM and copied in his assistant, asked the question, and then they came back to me and said, yeah, we'll do it at a lower percentage rate because they're still on a fixed rate. If they've got longer than 6 months to go, just provide evidence and we'll calculate it at a lower rate. And that increased their capacity by, I can't remember the exact figure, but it was a couple of, 1 or 200,000, and put them in a position to buy the property. And that's just recently settled and everyone's happy.
Yeah, nice. Nice. So I guess I'm just thinking out loud here for everyone's watching or listening. It's good to ask your broker then in that case, if the broker has asked various BDMs the right questions. I don't know if that's micromanaging your broker and whether you guys get pissed off at that or not, but at least, asking that, and then you can probably gauge very quickly, is that broker like a Colin, with a dog with a bone, like really going at it, really trying to find a solution, or if they're kind of whimsical and a bit nonchalant about it, and in that case, you might want to switch brokers.
Yeah, well, that's really up for you to decide. And, I do get people approach me and they've spoken to some brokers, and it happened on more than one occasion where they said, I didn't feel like I was talking to a person. When I'm talking to you, I feel like I'm talking to a person. So
Yeah.
I've never had a finance background, so maybe those brokers had a particular way of doing things because they've come from banks. I don't know. I've just created my own style and it seems to work. So
Okay, nice. All right. Well, that's the second one. The first one was great. The third tier lender that
yeah.
didn't take those expenses on board as others do. What's the third tip that you have?
The third tip is accessing equity. So you have to be careful which lenders that you set your initial purchases with, because a good thing to have in mind is, I've put my deposit in to acquire this property, and then I want to get that deposit back so then I can rinse and repeat. So you've got to be careful that the lender that you're with, if you go back to get that equity, and in the meantime you've required maybe one or two more properties and you're getting towards your borrowing capacity ceiling because you put them in your own name, you've got to be careful that when you go back to that lender and you go to access, say, 100K equity that has happened over that time frame, and then the lender will say, what do you want this money for? And you'll say, well, I want it for a future deposit for an investment property purchase. And then this is where you can get caught out and not having the knowledge. They will ask you, what property are you purchasing? And then they will want that to fit within their calculator and to service the debt. So that's just a little key there to make sure when you speak to your broker that if you're putting a property with a particular lender and you're doing it in a certain order, this is on the assumption that you're buying it in individual names. And by the way, that's 95% plus of people. Very few people use the other strategy, but hopefully that will grow in popularity. So that's something to be aware of, is what is that lender's policy if you go back and access the equity, because some lenders won't ask any questions. They will just go, oh yeah, they're using it for a deposit plus cost for a future property investment. That's fine. They've already got 2 or 3 properties. They know what they're doing and they release the money. So you just got to be careful you can get caught out there.
Right. So even for your first property, even though you might have borrowing capacity for another 1 or 2, make sure you're going with the right lender that will then allow you to take equity out for that 4th, 5th property in the future. So really getting that
Exactly
lending
right.
strategy like right up front, and not being complacent and being like, oh, I can borrow $1.5 million, doesn't matter who I go with, it's all good kind of thing.
Yeah, correct. That's
Yeah, right.
exactly right.
Awesome. No, those are some great technical, I would say, tips where we're building our knowledge, and I really feel that property investors should, obviously they can't know as much as mortgage brokers because there's dozens of different lenders, different policies, they're always changing. But I really feel a good property investor knows enough about the finance or lending game to be able to ask the right questions and not put pressure, but like, get the right targeted outcome or results from their mortgage brokers. So I think these tips are going to help a lot. And then let's go to the questions. So like I said at the start, everyone who's watching or listening, there's about 10, 15 questions. We'll go through them pretty quickly. But once again, the answers of these questions, they may improve your borrowing capacity, they may just unlock another property, or overall, they may help you restructure, reshape your property investment portfolio, or indeed start one with the right foot forward. So the first question from, I might be pronouncing names wrong, from our Facebook members, Sabir, I think his name is. He's saying, how do we remove cross-collateralization successfully? So cross-collateralization, Colin probably does a better job at explaining it than me, but that's when you have 2 loans with the same bank and the bank has used the first property as security for the second property. So Colin, like, I mean, in almost all instances, this is not a great thing. Sometimes cross-collateralization can help borrowing capacity a little bit, but there's risk involved. If someone has cross-collateralized, why is that bad and how can they undo that?
Well, there's 2 basic ways to structure finances. One is cross-collateralization. It's typically the bank's favorite way to do it. And the other is standalone. And the dangers of cross-collateralization, I've actually got a printout that I give to people, and there's 10 dangers of cross-collateralization. So I'll just talk about a couple of them. It's when you get properties valued, and if you have 2 or 3 properties that are what do they call cross-collateralized or securitized together. So it's the 3 values of the properties all lumped together, and then there's a certain sum of money borrowed against that. It's okay if the markets are rising. It's when markets stagnate or start to go backwards, and then you get valuations done. You could have 2 properties secured together. One property could come in a low valuation. Another property comes in at a low valuation as well, and then you don't have as much equity. So cross-collateralization is essentially just uncrossing those properties, creating maybe 1 or 2 more loan splits, and you just apportion the debt that's secured against one property that may have been used for another, and that's the way to do it. So that's the main issue, is that when it does happen to people, it'll be like deer in the headlights situation. So when things go wrong, they can really go wrong, and cross-collateralization won't be your friend if, for example, evaluations come lower than expected. There's many more reasons, but that's pretty much the main one.
Right, right. Awesome. All right. Well, the second question from Anne, she's asking, and she's asking this in the context of trying to reduce your mortgage rate. So, one way that I often say, I've done a whole video on it, is you can just call your bank and ask them, hey, I've got this better offer on interest rate from this other lender. I'd like to reduce my interest rate. And then they go off and think about it just on the phone a lot of the times, and they talk to their supervisor or whatever the case may be, and they say, look, sorry, can't really do that. Or, yeah, in fact, we can do that based on, your rents have gone up, the LVR's come down because the valuation's gone up, etc. And then happy days, small interest rate change might save you thousands of dollars over the year. Anne is asking, you know, what do you do first? Do you call them or do you just ask for a loan discharge notice? I think she's maybe also confused what a loan discharge notice is. And like I often say, you ask them for a reduction or a discount. And if they don't give it, you ask for a loan discharge notice. And it's kind of like calling their bluff, because when a client or customer asks for that, then they really take
Mm.
it more seriously. But then what if they do issue you a loan discharge notice? I think her question is, are you obliged to actually go ahead and remove yourself from that bank, or any tips around that, Colin?
Yeah, sure. So I would, the first port of call would be your broker, because the banks have given us mechanisms and tools, what they call pricing tools, to then put in the customer's details, send it off to the lender, and then someone at the other end, sometimes it's automated, will have a look at it, and then you put in your reasons, and they'll come back with a counter offer, and then you can accept it or you can challenge it. There is one lender, and there's quite a popular lender, one of the most popular lenders in Australia, and they have a really good process where you can either get your broker to do the pricing for you, and then the bank has to come back, and then if you're not happy with the offer, then you organise a discharge process. And with this lender, they send you a link. There's all sorts of games that are played in the background around discharges, because what you've got to remember is the bank's losing business, and it's cheaper to keep a customer than acquire a new one. So yeah, best port of call is your broker. They challenge the bank and say, this lender is offering this rate, what's the best you can do? And then lenders have different appetites. Some will be pricing hard at certain times, but that's for brokers to work out anyway. So you send in the pricing and then ask for a discharge link. And then when the mortgage broker then refinances you to another lender and the discharge team happens to ring, and they're quite aggressive, so they'll wait till there's a PEXA invite created. So that means that the deal is ready to settle, and that's when they'll ring up the customer and offer them like a really good deal. So the way to trigger that process is through lodging a discharge form, and different banks have different quirks on when the retention team will call you, but the broker should know or be able to find out. So the idea is to trigger a call from the retention team, and then they'll give you the best offer, which will be much better than the offer that they originally gave to the broker. It's
Right.
silly games that have been played, but that's just the beast that we're dealing with.
Yeah, play the
So,
game that's in front of you. It's fun. I don't think it's stressful at all. I think you just embrace it and go along with it. The next
and
question.
just before you go on with discharge notices, yeah, you don't, there's no obligation to proceed.
Mhm.
It's the same with everything. You can get contracts for a mortgage and then decide not to proceed, and yeah, so
Got it.
there's
Got
no
it.
obligation to proceed. And there are legitimate ways to, if you get yourself in a pickle, there are legitimate ways to get yourself out of it, and a good broker will know that.
Good one. Perfect.
Yeah.
Next question's from Alicia, and she's asking about bank valuations. So the gist of her question is, let's say you've just bought a house, and
Yeah.
2 weeks later, there's a very similar property just down the road, same comparable type of property, sold for 100K more. Does that immediately trigger in the bank size that your property is worth 100K more now as well? Or how lagged are the comparables that they take when valuing your property?
Okay, so there's three types of different valuations. There's what they call a desktop valuation, which just essentially means it's generated using algorithms, I suppose, from core logic, however they program that. And then the second way is what they call a drive-by. So the valuer will just drive by, see there's a property there, and then do a desktop valuation based on that information. And they're not very popular anymore. And then the third one is a full walkthrough. So in regards to a property similar to yours selling for an increased price, I don't know exactly how the algorithms work when it comes to CoreLogic and how they do things, because they're the main valuation data firm. There is, however, typically a 3-month lag. So the valuations you'll get from desktops in a bull market like we're in now will probably be lower than what the actual property will sell for that day, if that makes sense. So you may have to wait a month or two to pick up the benefit of a similar property to yours selling for a higher price. So valuers typically rely on properties that have settled 3 months or longer to use as comparables. So there will be a lag there that you may just have to be patient and then go back in a couple more months, do another desktop. I'll go into Property Hub and do desktop valuations on a property, and it will change day to day. So
Yeah. And this is the thing. I think a lot of people, I mean, that's on a post-purchase decision, but on a pre-purchase decision, a lot of people, I think, get into this trap of going on to like ANZ or CBA or whatever bank's website, or there's other websites out there, free and paid. And I honestly feel that none of these automatic valuation generators, whether it's an exact number or a range, are accurate at all. And everyone should do their own valuation based on understanding, simple things as well, like bedrooms, the age of the property, size of the block, and then other qualitative factors as well. There's nothing that can replace doing it yourself, because you'll see the most recent comparables, and those qualitative things aren't often reflected in the quantitative algorithms. So always do those valuations yourself. But it's good to know around 3 months lag is what they take. Thanks for answering that, Colin.
sure.
The next question here is a bit of a generic question, and let us know, Colin, if perhaps the question is not can't be directly answered because it's so vague. But Daniel's asking, which lenders provide the most servicing or borrowing capacity for trust structures these days?
Okay. Time to time. Which lenders provide the most servicing borrowing capacity for trucks? That will come down, and I know it's probably not what people want to hear, but it does come down to your individual circumstances, because there's so many criteria that are assessed when a lender's deciding how much they're going to borrow you or not. And it does vary with lenders. So the same rules would apply if you're going for trust lending as you are with individual lending. There would be certain lenders that you do in particular orders, and it would basically work out how their individual servicing calculators work and putting the correct data in there and just comparing the numbers. Once again, to go back and get equity from property and trust, you can run into trouble as well, because you may not have the serviceability because of properties that have been purchased in individual names to accomplish that as well. So yes, there would be. It would just come down, because you can put one person's scenario in one calculator and then put another person's scenario that's very similar in that same calculator, but there's a few little differences that end up giving you a different borrowing capacity figure. And these days, the deals all come down to, a lot of the times, the borrowing capacity. And when deals are really tight, they're a lot of fun. And sometimes it's hard for people to understand what's going on. And I do my best to explain things to people without, confusing them.
And do different banks, do they, like, in terms of this question, do different banks prefer different professions or occupations? So let's say, I'm just making this up. Let's say I'm an accountant and you are a nurse, or, whatever, pick a profession. Would one bank be better for me because they like these types of occupations, and therefore I would get a better borrowing capacity versus you, and vice versa?
Yeah. Well, banks risk rate everything, and that includes what profession you do. So they'll have data that they've collected over perhaps decades, and they'll know that an accountant who works in a suburban practice and earns $100,000, they'll know that every accountant that they've got in that demographic over the decades has been a low risk. So yes, they will risk rate professions. And as far as borrowing capacity is concerned, that won't change. That comes down to the hard data, what the numbers say, basically money in, money out, and what's left is the surplus, and they'll determine your borrowing capacity. So that won't change. However, banks do look at character, and assuming you tick the serviceability box, then they will definitely look at character and also profession as well.
Right. So the answer to
Yeah.
the question from Daniel also depends on their profession, on his profession, in terms of which lender, would be best suited for him.
It depends on many factors like his rental income, his employment income. He's an essential worker, so we can use 100% of his overtime, for example, where it's normally shaded to 80. Little things like that can make all the difference.
Right.
Sometimes you get the perfect storm that just adds up to all the right things, and other times you get a perfect storm that doesn't. I still don't give up.
Okay.
I very rarely, I usually get most of my deals over the line, and when someone comes to me, that's my jam. That's what I get excited about, hearing their story, hearing their pain points, hearing their victories, seeing where they are, and then taking them to the next level. And that is my passion, is to help people create wealth, because when I do that, then it happens for me as well. So it's a beautiful thing.
Brilliant, brilliant. Next question here from Krishu. What he's asking here essentially is, if you go to a bank directly, do they have more lenient borrowing capacity calculators or assessment factors versus whether you go through a mortgage broker? So let's just, this is a bit of a hypothetical. Let's say I walk down to my local bank. I bank with CBA. So let's say I go to CBA, and maybe I'm not the best example, but let's say a new property investor goes to CBA. Will CBA give that person the exact same borrowing capacity versus if that person contacts a mortgage broker and that mortgage broker goes to CBA?
Okay, there is a saying in the finance world: you've got branch land and then you've got broker land. Now, branch land sometimes have different criteria or different ways of interpreting the income, and then they will get a different borrowing capacity figure. How they do it sometimes is a mystery to us, but it is possible, and there is different criteria, unfortunately, that applies to branch land and to broker land. So it is an issue of contention in the industry to try and homogenize it all. But typically you should get the same outcome. If you're taking the same data and applying the same lending obligations, which people working in branches are still under, brokers are under a different set. It is more strict, and sometimes it is a pain in the backside. However, it's to give protection to both the consumer, the client, and the broker as well. So yes, brokers do have to verify and check information perhaps greater than what someone at a lender would do. And not saying the lender's doing anything wrong, they just have different criteria and different legislation to work under, and a corporate structure as well. And then brokers typically, a lot of them are self-employed, so they have to work under whatever their aggregator advises them in regards to how they will go about doing things. And the compliance teams are very thorough as well with the aggregators. So it is quite regulated, but it gives people peace of mind that we as brokers have to now justify why we put someone in the product and the lender and the position that they're in. And even 10 years later, if we get called up, hey, why did you do this? We have to be able to explain why. So
Wow.
yeah, it's a good thing.
Yeah. Cool. Let's take a few more questions. So the next one is from Vira. He's asking LMI exceptions. So of course, as everyone knows, if you put in a deposit of less than 20%, or in most cases, you have to get lender's mortgage insurance, which is something that can be capitalized onto the loan itself. And it's really insurance for the bank as opposed to you, in case you don't pay your debt because you've not put down 20% deposit. It's completely fine not putting down 20% deposit, but then you cop this LMI, which in my mind is a cost of doing business. You want to get into the market as long as you know what you're doing. than wait on the
Hmm.
sidelines. But Virat's question is, which are the professions that have LMI exemption? Because some professions from a lot of banks, they don't charge them LMI. And specifically, he's asking, it looks like he's an IT professional, so he's asking about 10% deposit for IT professionals. Are there any banks that provide LMI exceptions? And maybe you can also share, Colin, which are the other professions that get that LMI exemption?
Sure. Yes, there are different banks that give different offers in that regards throughout all the different tiers, from first tier, second tier to third tier, and it's called no LMI basically, and it's available to doctors, to lawyers, to accountants, and also some lenders will open it up to other professions. Like, say, for example, physiotherapists may be available on one lender but not another. So it's definitely an offer that lenders give. And once again, it comes back to risk rating. So they've collected data over the years with people who work in those professions, and they're considered very low risk. So that's why they'll offer that. Uh, in regards to, I'll just read the question, LMIs into IT professionals. Yeah, there are some lenders that will do IT professionals at the moment. It's just a matter of asking your broker, hey, this is my profession. Is there any LMI waivers? You've got to weigh up, though, that you'll go to a certain lender and they might charge higher fees and maybe a higher rate. So it may not actually work out. But it's definitely a leveraging strategy that you can apply to put in less deposit and then save that money on the LMI, because it's typically around that range. It's about 2% of the total loan amount. So it's definitely a good saving, and there's definitely options out there, or sometimes a wide range of professions actually.
Okay, good. I didn't know that about the IT professionals, but it's good to hear that those folks can get it in some cases. Adam is asking, before applying for a pre-approval, of course, the banks look at your expenses as well, your household, budget, basically, household expenses. Effectively, Adam's asking, leading up to your pre-approval, let's say for the preceding 3 or 6 months, is it a good idea to be really frugal and maybe where you normally spend X, spend X minus Y. And in that way, for the last 3 or 6 months, the banks see that, oh, actually, this guy can afford this property or can afford the next property. Is that a good way to go about it? Or do they see the forest from the trees and look at multiple years of bank statements and things like that?
Okay, so in regards to HEM is essentially the basic minimum figure that banks will accept, and they won't go below that. So really, if you want to find out where that tipping point is, ask your broker, what is my HEMS or what is my minimum borrowing living expenses figure, and then just make sure you're below that. If you go really frugal, there's not many lenders, if any, because I think we're bound by law to use that as a minimum figure to abide by responsible lending. So that will be good personally, because you'll be able to save that money and then reinvest it. In regards to going below that HEM figure, there's no real advantage. But definitely, if you are above it and then you need to get below it, and some lenders will drill down into it. Some lenders will just accept the figure and tick the box and move along. So that also comes down to which lender and when. And so that also factors in to that equation as well, believe it or not, how the lenders will look at that. And it's pretty much homogenized. But it's funny enough, because the HEM figure is different for different lenders. They set it at different amounts. That can also get you over the line where it otherwise wouldn't with serviceability.
Right. And just as a rule of thumb, or if there is a rule of thumb, what is like that watermark for him? Like just on average, per month, what is the expenses that even if you don't spend that much, the banks are still gonna, think of it as a minimum threshold?
Single person, just off the top of my head, around about 2K per month.
Mm-hmm.
And it will vary between lenders. Some go as low as 1,800, some will go as high as 2,500. A couple with 2 children would be typically around about the $5,000 mark. And you can change the postcode, and then the HEMS figure will change. So that's how detailed they go with it. So.
Right. So I think it's a good idea to check with your broker what that watermark level is, and then, don't be unnecessarily frugal if it's not going to make any difference. Okay,
Well,
let's
if you
do.
want to be and you save the money for your deposit, you got more for your deposit. So why
Oh
not?
yeah.
Some people enjoy being frugal.
Nothing
Yeah,
against being frugal. No, that
yeah,
for a deposit purpose, that's a good call out. Last two
yeah.
questions, Colin. There's one here from Ketul. Is it
Okay.
worth refinancing with the Bank of China, who are offering a better rate? Are they regulated by Australian financial authorities?
To answer the second question, they're a regulated bank. And is it worth doing? Well, that's up to you. I have heard that they do take quite a long time. I don't want to misquote them. That's just what I've heard on the grapevine. They do have very sharp rates. Rates isn't what you want to be chasing as a property investor as well, because that bank may not be what will be suited for you down the track when you want to go back, say, for example, and access some equity. They may have certain restrictive rules around that. Their servicing calculator, which I haven't actually looked at, may be at the lower end compared to other banks. So, look, if you're just chasing rate and you want to keep your rate loan repayment as low as possible, yeah, it may be worth exploring. The chat to your broker once again and get their feedback too.
Yeah, I have not heard of anyone going with Bank of China, but might be one worth exploring. And the last question, Colin, as a sort of general question, there's a few people asking this one, is how
Mm-hmm.
do you find an amazing broker? Because I think when you first think about property investment, maybe a little bit noob, you're like, I just want the lowest rate. But then you start watching episodes or listening to episodes like this, and you're like, all right, there's more to than just getting a lowest rate. There's different entity structures and there's different professions and there's different ways to understand borrowing capacity, etc., etc. And then it becomes quite overwhelming. But what are like perhaps three ways by which people can ascertain that, yeah, this is in fact a good investment savvy mortgage broker?
Okay, well, these days you have a footprint online. So if you like what you're seeing, say from the comments and whatnot, you can always do further investigations. And often people will come to me and say, yeah, I saw you on Property Chat, which I'm also an active member on, or I see you on Pico's group. And yeah, so then they can do their searches and do Google reviews and then check anything that may be untoward about you or whatever. They can do their investigations essentially. So that's one way of finding it. Another way is getting referred by someone who's used a broker. That can be a good way too. And third way would be reaching out to them and then giving them a call and then having a chat to them and then seeing how you feel about it and make a decision from there. So there are three ways you can find a broker.
What's like a real technical question? Sorry, I'm putting you on the spot here. What's like a real
I
tricky
love it.
question that someone can ask a broker to really, find a gem? What's like a technical like lending question that, might stump a marketeer broker?
Technical lending question that might stump a marketeer broker.
That was my term that I just made up, by the way, marketeer
No, I
broker.
know what you mean. I know what you mean. I'm just trying to think of something relevant. You could you could basically ask them how long they've been doing it, what is their specialty, what is their niche, and typically a broker may say I do everything. So if you ring a broker and then ask them what is your niche, because there's so many different deals you can put together in this industry, even amongst property investing, there's such a wide variety of how you can do things in people's scenarios. So you can just ask them what their experience is and what their niche is, what they specialize in. And then if you are somewhat educated or perhaps a lot educated and you've got knowledge, you can then ask them certain questions that perhaps you know the answer to and then to see if they're on the same page.
Right, right. And of course,
Yeah.
another one is whether they're a property investor themselves, whether they've, I mean, they don't need to have 20 properties to show that they know what they're doing, but more than one property, more than two or three properties always helps as well. So I will
Yeah, that's a
probably
great question to ask too, definitely. What's your
yeah.
experience in property? But property was what got me into mortgage broking, not the other way around. So.
Yeah, yeah. And I was just going to
Yeah.
say, and that's something that strikes out, of course, about yourself as well, Colin, because you've been a property investor for longer than you've been a mortgage broker, and I think that's probably the right order in which to do things. But thank you so much for your time. We've gone, you know, chopped and changed around different topics today. You shared with us a few technical ways to improve borrowing capacity at the start. Before we end, is there anything else that you'd like to say?
No, that's all. Thank you so much for the opportunity. It's been thoroughly enjoyable talking to you.
Cool. Awesome. Well, thank you very much, Colin. And hopefully this brought you value, guys. Lending or finance strategy is as important as suburb selection, is as important as property selection. And I always say it's a bit cheesy, but the door to success opens inward. So before you rush out for the next hotspot, quote unquote, etc., just take a step back and really understand like these fundamentals of property investing. Develop your lending strategy. First of all, educate yourself what the key pillars of a lending strategy are. Then, when you're up to speed, then you can engage with a good mortgage broker like Colin, or whoever that you wish to go with. And then you can actually build a comprehensive game plan, not just for the next 4 months, 6 months, or a year, but over the next 5, 10 years. Strategy, game plans, these always change, they're always dynamic, but it's good to have some sort of solid foundation to start with, off which then you can shift and pivot as your life situation changes. Hopefully, it brought you a ton of value. Like I said at the start, we've done other episodes with other brokers and also lawyers on how to get unlimited borrowing capacity through trust structures, non-conforming lenders as well is another way to get improved borrowing capacity. But hopefully, all these episodes are bringing you a ton of value. Colin, if I forgot to ask you, if people want to reach out to you or find you or something like that, how can they find you or how can they reach out to you?
Most people just send me a private message and just answer that way. Or I've got a website, www.cdrfinance.com.au. You can see me on Property Chat and PK Gupta's group. So just click on my name and do your due diligence or send me a private message and we can take it from there.
Good one. All right. Well, thank you so much, Colin, and thanks everyone for listening. Cheers.
Thanks, PK. Goodbye.